Hey guys, Freaky Finance here. Today I got a fun one. We're staying in Canada. We're doing MTY Group. We've done tuck-in plays before. We did a video on Alimentation Couche-Tard, which is probably one of the poster childs of a tuck-in. That was a gas station play. And this one's more of a franchise tuck-in play model for fast food service, QSRs, diversified across a lot of different ways. We're going to go into that. They have 90 different brands, so there's a lot of brands. And just looking at them, you can kind of see where they're positioned, and we'll talk about the revenue breakdown between them. But they do a lot of business in frozen treats and smoothies, a decent amount in American, a decent amount in Mexican, and a decent amount in Asian and Indian. But you can see there's a lot of different brands, so they have a lot of exposure in a lot of different places. So they're not at the mercy of any one current trend that's happening in food, because they have such a spread out footprint, I'd say, both in terms of where they are as well as what they sell. The top 10 brands, however, are pretty critical, right? 64% of system sales. So Papa Murphy's, Cold Stone Creamery are ones that they constantly talk about. Same with Wetzel's Pretzels and Village Inn. And you can see the breakdown here between the different segments in terms of what's generating most of the revenue for the business. You can see Italian's only 2%, breakfast only 3%. But you can see it's pretty well spread out, except a little bit of concentration in frozen treats and smoothies in American, but still probably one of the more diversified parts I've seen for a QSR. To have so many different types of options, right? It's also now dominated more in US than it is in Canada, even though it started in Canada. You can see the US just drives a lot more business, and they have more locations now in the US, over 4,000 of their 7,000 locations. One of the reasons why we're going to do the video today is what I like to do is look for companies that are hitting 52-week lows. So this company recently reported, and they hit 52-week lows, so my alert showed up. And so I was like, I gotta look at this business. And I could see that the business, even though the main thing, if I had to sum this up, is that the EBITDA is down year over year on the 9 months, but you can see on the last quarter, it's finally starting to tick back up again. And the share price went down. And that's what I start to look for, is what's starting to inflect back to rate of change positive. Well, I'm still getting a good deal. And we knew QSRs were weak. That's been the news for probably a year. Basically, a lot of these restaurants took a little bit too much price, and they've been losing share to, interesting enough, they lost share to like Darden's of the world. So like the actual dine-in restaurants that actually took share, which was interesting. And part of that was because a lot of these guys took a lot of price. Here's another reason why the share price, I think, is under pressure. As longer run, the franchise model is fine, but they basically ventured more and more into company-owned stores, especially lately. And you're seeing the margin profile overall, even though revenue is shooting up, and EBITDA is also way better than it was, right? 267 million last year versus 51 million in 2015, right? So more than 5x the EBITDA generation in absolute dollars. But you can see the margins come down for the overall company. Part of that is they've switched from more franchise dominant to now being more balanced between franchise and company owned stores. And we're going to talk about that difference in a second. Let's just go into it right now. So when you first look at the location number, you'd think, oh my God, there's 6,000 of the 7,000 stores. Most of them are franchised, right? And there's only 256 corporate owned, right? So 97% franchise almost, right? And franchise is great. The market generally loves franchise models. Basically, you just ride the revenue. So if inflation's high or low, basically they just make more money on the royalties. So just a fee that they charge the franchisee. They also get rent and sometimes initial renewal fees. And then one of the cool things with MTY is that they can also ask them to buy specific supplies and food and equipment directly from their own distribution network at MTY that they also have. So there's some innate synergies here as well. And it also branches over to their company-owned stores because they'd also be buying the same stuff. So it's a way to basically get more sales for your ingredients to more places. Now, on the franchise model, what's great is that you're not responsible for the food, the labor, utilities, anything like that. You're just really just riding the royalty of the brand. So top line revenue is lower, but provides extremely high, stable, and predictable profits, right? So you're only getting 3 to 7% of the sales that the actual store generates, right? And this is just to basically show the difference. The direct costs are obviously higher, but the revenue is also higher for company-owned locations. Capital costs is also higher, so you're going to see capital costs actually relatively low for the business, but it's higher for company-owned locations. And the risk there is also profitability is sensitive to costs. So as costs fluctuate up and down, you're going to see that more in the numbers, whereas you get more of a stable, steady state of profitability with a franchise model, right? And the AI is right here. It kind of picks up on a lot of things. And this is also important to notice that 100% of the restaurant sales for company-owned stores are on the books. So a store that's owned by the company shows up a lot more than a store that's franchised outright in terms of revenue, because you're only booking 3 to 7% of that store sales, whereas now you're booking 100%. And here, AI is right, again, volatile and directly impacted by inflation and wages and food costs, which have recently, I'd say over the years, got lower multiple. I should show here that I do own this one. It's not full size, a 1.3% position, but I thought it would be interesting to do a video on today because there's not a lot of things that are down today or this year to date, right? Almost everything's up. So I'm trying to dig over more and more rocks. It's getting harder. It's this one is pretty interesting. The strategy, the tuck-in strategy, I'd say has evolved a little bit. So historically they've been tucking in smaller regional brands, but lately they've done some bigger transformational acquisitions in the US, like buying Papa Murphy's and Barbecue Holdings, and it also pushed them into dining segments like casual and fast casual. So again, more diversity, but different business model, lower margin, and potentially more risk. But also sometimes if businesses are doing well, you'll see it better. That's what volatility means. You'll get more ups and more downs. Well, cost synergies are derived from the centralized procurement, shared back office services, and elimination of redundant public company costs. Here I wanted to see so when they buy a company, whatever it's 7 times EBITDA or whatever it is, I wanted to see how many turns they can get out of it in terms of synergies. The AI is basically saying that historically the company's been able to get 2 to 3 turns of improved EBITDA, and it kind of depends whether the business is small or large, how much they'll be able to get out of it. So a smaller acquisition, you're actually going to see more synergies, and a larger acquisition, it's usually harder to realize, I'd say, or at least you don't get the same amount of wringing of EBITDA out of it after you acquire it. AI is right here that when you acquire things, your debt level also fluctuates. So when they acquire these bigger things in the US, you're going to see the debt increase, and lately, I'd say over the last year and a half, they've been starting to pay it down rather aggressively, I'd say. So the debt's only around 2.3 times EV to EBITDA now, so relatively small. And the 2 to 3 range is usually pretty safe. When you get to the 4 and 5, it's usually a little bit dicier, I'd say. It depends, but that's a rule of thumb that I say. Trend has been lower margin, which we talked about, partially because they pushed more into company-owned stores versus the franchise model. The franchise model, however, has been constant. It's been showing up and doing well. It's just overshadowed by the company-owned stores. Here, I asked AI to try to figure out what the recent transaction multiples were for certain things like Papa Murphy's and Barbecue Holdings. And you can see they've acquired them, pre-synergy, 13.7. I was looking at numbers, and some of them are 6 to 9. It really depends on what the business is, and if it's a franchise model that they're buying or a company-owned store model that they're buying. The cost synergies are pretty simple, so shared services, bulk purchasing, less investor relations, filing, auditors, insurance, office space. So that really shows up, especially the later part on the small mom and pops. You don't have all that overhead, right? You're literally just one company. You don't need all these different people. And the bulk purchasing, I would say, is also very important, especially if you can use the same ingredients in different restaurants. Revenue synergies are kind of interesting. The AI, I thought they're it could have done better. Kind of surprised they don't mention the scale of the marketing arm, being able to market more on behalf of your franchisees wherever you want to market at certain times. And basically the AI just says it's more diversified. It has more geographic expansion and digital marketing platforms and portfolio diversification, which is all true, right? But it's not, I don't know if that's a synergy. That's more of a strategy. The franchise segment generates high margin royalty based on percentage sales, where the corporate segment realizes the full top line sales of each restaurant operates. So while the stores, we see it's largely franchise, and that's what they advertise, you can see in terms of the revenue, corporate stores, even though there's only 200 of them, of the 7,000, are a bigger portion of revenue dollars. Ultimately not EBITDA dollars, but that's another point altogether. Here I wanted it to dig deeper, so I was like, what did they get out of this one? So basically for the IMES course case study, they bought it according to AI at 13.2, and they're able to bring 2.6 turns of EBITDA out of it. And that's what you want in a tuck-in play. You buy something, you bring out synergies out of it, tuck it in. And that's what a tuck-in play is. That's what Alimentation Couche-Tard does very well. MTY has done very well over the long run, but over the last, I'd say, 3 years, it hasn't shown up as easily. So when I like to look at tuck-ins when the place is out of favor and the company that I'm looking at is in a position to take advantage of it. So I know QSRs are still relatively out of favor. They're not as bad as they were. Like, we had one of the proxies we're going to talk about in a second is Lamb Weston, and that's one that's already inflected. It's up 20% in the last 6 months, and 85% of the sales in North America are basically from the QSR. Would you like fries with that kind of thing? And we're seeing that inflection already, and you're seeing that in McDonald's numbers as well, that the same store sales are finally getting better again. And so that's why I'm like, oh, I can still do a video, because even Wendy's has gone up, right? There's certain things that have starting to come back up, and this one hasn't, even though the business is looking like it's getting sequentially better instead of worse. Not that things are great. That's why the EBITDA or the EPS is only at 8 times earnings, but it's finally getting less bad, and that's something that I look at as a catalyst for when to start looking at a company, especially when it sells into it. The great thing about this contrarian gambit that the AI talks about is when to look at tuck-ins is the valuations that they're buying finally come in. So as long as they have money to take advantage of the pain, they come out on top, and usually they get the best deals they'll get is during this part of the cycle when people are gone, right? When times are tough, there's less people that bid for businesses because they need to shore up their own, right? And this was probably one of the best comments on the call. And basically they're asking, what about M&A, right? That's kind of their bread and butter. And he said there's a good amount of deal flow at the moment, just a matter of finding the right deal. There's been a lot of corporate store networks that were not necessarily interesting. There's been a lot of fixer-uppers, a lot of Chapter 11 situations, so bankruptcies, which is not a thing I look for. What I'm looking at, I want to see is capacity coming out of the system. Is there more restaurants that are failing right now? Yes, that's what it's telling me, right? That's another time when I'm starting to look at the industry, right? Especially a company that's set up to take advantage of that pain. So the market, they feel is starting to be in a better place now. It's just a matter to be at the table for the right deals when they come. So the market seems a little bit more favorable at the moment for MTY. So there's also and slightly better opportunity than there was a year ago. And that's what I like to see. The mindset of the CEO needs to be like this. This shows true understanding of what's required. The 5 years are pretty interesting. You can see relatively aggressive growth, but again, a lot of these are fueled by acquisitions. But you can see the EBITDA going from 137 to 264, and you can see the year-over-year decline here and slowness. And that's the large, like one of the most important lines here. You're going to see impairment charges as well. So when you acquire things, you generally have goodwill because you're overpaying for them, usually. And then every now and then when things get tough, you also have impairment. And that's usually when you get deals on the share price too, which is nice. When these impairments aren't cash, they've already paid the cash down like way ahead. That's why they have the goodwill on the books that they're finally now impairing. So anyway, it actually helps in terms of cash. And you're going to see that the cash flow, they spot on here. You can see the earnings fluctuate like crazy. But in terms of cash flow, right here, you can see it just slowly walking up every single year. Like 133 million, 139 million, right? 204 million. And the CapEx has barely gone up as well, right? Like it's starting to go up a little bit more because there's more corporate stores, but overall you're seeing the free cash flow go from 126 million to 177 million, right? Which wouldn't be indicative if you just looked at the P&L on the income statement. Another thing I like, obviously, is the valuation. It's gone, like I said, down 25-30% this year, which is super nice. Well, there is also some buybacks that have been happening in the past as well, which is also reducing the share count, which is another thing that's nice. So the equity EV used to trade at 1.2 billion, 1.5 billion. Now it's only at 800 million, right? So that's the deal. Well, the free cash flow has only improved. And on the latest quarter, we're seeing improvement again, finally, which is what I look for. What they're doing with the cash, a lot of it spent on acquisitions in certain years. Recently, I'd say a lot of it's been paying down debt. They've been paying down debt again this year as well. And then now and then they start to do buybacks. And I would like them to start doing buybacks because if you're buying, we're going to talk about the valuation in a second, which is only down, their valuation is down to 5.5 times EBITDA, which is extremely low, especially for a company that's trying to acquire companies at 7 times. Or 6 times. So the fact that you're not buying back your shares right now when your valuation is this low is a mistake. They should be buying their shares back right now. It's a capital allocation error. Anyway, dividends paid is also easily covered by the cash flow. You'll see it pays like 3 or 4%, whatever it is. But this thing is a long term. You can see it's growing very well. Well, I'm getting it at 8 times earnings, right? So, and it has a history of doing this. It is a cash flow machine, and the valuations finally come into something where I can entertain owning it. That's why I do. I just wanted to show the consensus EPS expectations here. If 4.34 is actually true, I mean, they just put 3.23 on the 9 months. They're almost there anyway. If that's true, at $35 a share, it's at 8 times earnings, which is nice. One of the reasons why I'm super excited about it now is that fast food was declining for a while, but appears to be bottoming if you believe McDonald's and Lamb Weston. So things are starting to normalize. right? Lamb Weston's up 26.5% in the last 6 months, finally. Right. To be fair, it was down a little bit more because they had their own issues in the organization, but you can see it's starting to rebound. And 85% of the North American sales are from food away from home channels, and the majority of that volume is sold through QSRs, as per the CFO's April commentary. That's a thing that I look for, is like the industry finally starting to get better again. And this is also a rate of change inflection story. So what basically same store sales down 3.8% in Q2, and at least latest quarter is only down 1.6%. So not good when your same store sales are down, but this rate of change is very important for me to build comfort, especially when it sells off again into it. So rate of change is improving and decline. Multiples come from 14 times earnings to 8 times earnings. So market, in my opinion, is likely extrapolating the current negative trend forever, as it does in the past. It's very myopic. Whatever you're recently putting up assumes that's what you're going to do forever, right? And that's when you can find things, especially when they're getting sequentially better. It's kind of nice when you're getting an even cheaper price. In terms of the earnings expectations, we just talked about them, but again, implied forward P is very low, 8 times, 7 times 2028. You're actually, analysts are expecting 2026 to be worse than 2025, even though right now the company is basically telling you things are getting sequentially better, right? We just saw that in the latest quarter. So that's going to be interesting when you have something that's sequentially getting better already, and earnings expectations are expecting things to still get worse than what they already were, when you've already seen the industry start inflecting again positively. So that's something I also look at. So expectations are low. They're basically just follow the price down, which they do, which also leads to, I think, one of the reasons why we're outperforming so hard this year. In terms of valuation relative to peers, AI picked QSR and Yum Brands, but it doesn't really do it justice. But you can see QSRs and the McDonald's. McDonald's would be a higher multiple, right? Because more franchise. The more franchise you are, the higher multiple you get, is a rule of thumb that I'd argue. But the free cash flow yield at MTY is just insane, right? And net debt to EBITDA, I think they're at 2.3 or 2.4. So you actually have lower debt than the other ones at a cheaper multiple with this amazing free cash flow yield while the business is starting to inflect. Or at least that's what it looks like. So catalyst for re-rating, successful deleveraging. I mean, AI wants it below 2. I don't know if that's going to happen. I mean, if you get some good deals, because things were, like they showed in the commentary, like they're seeing an increase in bankruptcies or fixer-uppers, which they're not interested in. But we're starting to see that. So if the deals start coming through, then that could actually put pressure on the leverage again if they start buying things. But right now they've been paying off a decent amount of debt. I think they paid off more than 160 million in the last 5 quarters, 6 quarters, maybe 7 quarters. But they've been paying off a lot of debt that they took on already. So they're already in a spot to take advantage of any more pain. The AI's comment here I just thought was interesting and worth sharing. A valuation of approximately 8 times forward earnings and free cash flow yield approaching 20% suggests the stock is priced for a severe and prolonged downturn. A scenario that may be overly pessimistic. I thought that was fun. AI is always very kind of neutral in my mind. So to see it word things like that, I'm like, yeah, no kidding. Anyway, if I had to do the setup, the business is starting to improve and EBITDA again on the latest quarter, right? And the stock is down 25% into that, right? Go back to the slide. I just want to show the dividend slowly gone up over time because the cash flow is there, right? When you make 200 million in CFO, you only have to put 20 million back in the business, and then you paid, I don't know what they're at, $25 million or something. Maybe it's 35 million now in dividends. They can easily cover that. So anyway, if anything, the dividend is probably too low, but that's fine. I'd rather than buy back shares right now anyway. The net debt, like I said, has gone down. So from Q1 23 to Q1 24, it says 686 now, so down about 100 million, which is nice. They've actually paid down another 80 million of this to now Q3 25. So they're only at 600 million in debt now. So the debt profile has actually gotten better year over year and year over year again. So we have 2 years now of deleveraging, which is nice. And to be fair, it was higher after the larger US acquisitions that they did earlier. Here's just another way to look at the EBITDA. What I like to look for is how to do year over year. So last year they did 71.9. This year they did 74. But where's that growth coming from? And basically you're actually seeing corporate owned stores start doing a little bit better in terms of margin. Last year was really bad, only 8% margin. This year at 11%. The franchise model is always very strong. You can see at 56% margin there and 56% margin last year there too. And that also helps show where they make a lot of their money. So while the revenue is close, you can see the profitability skews still heavily to franchise model because it's just a money machine. The margins are just amazing, right? It's just way easier not to have to operate a restaurant and just collect royalties. Owning a restaurant and operating a restaurant is not for the faint of heart, in my opinion. We already talked about the debt load going down slowly over time. Net debt, so about 600 million now, which is nice. 650 the year before. You're seeing continued improvement on that end. The boogeyman is always the intangible assets. Those always get written down when times are rough, which puts EPS in terms of GAAP EPS. It gets hit. However, it doesn't affect cash, and it actually helps them in terms of taxes later. Which is just a weird thing to think about, but for a business model that really relies on cash and putting it back into making new acquisitions, it's important to mention. Here, just wanted to show cash flow statement again in the last 9 months. You're at 200, basically steady. You're actually seeing, again, rate of change improvement finally instead of rate of change decline. That's what I look for CFO. And then another thing I like to look at is, okay, of the 200 million you've made so far in 9 months, how much did you have to put back in the business? And then we had to put 10 million back in the business, which is nice, right? That gives you basically 190 million to play with. It's less than that because there's working capital noise. But you can see with that 190, 56 going to debt pay down, 26 going to share repurchases, 22 paying dividends, right? So these are all, in my mind, easily covered. And then what I would have preferred in Q3 is to take advantage of this. So if they don't make any acquisitions or acquire anybody soon, they should be buying back their shares like crazy at the current multiple that they're getting. And take advantage of 8 times forward earnings, and with expectations expecting more pain, even though the current business is starting to get sequentially better. Here's the share price trading down into what looks like something that's sequentially better, which is what we look for. Longer term, the business has done quite well. It has a history of actually generating revenue, making good acquisitions, being a good capital allocator. This is the COVID shutdown. Restaurants got closed, and they made some larger acquisitions up here. So maybe the market's saying you might have overpaid for these U.S. properties that you bought, these larger stores, company owned. Who knows? But all I know right now, we're at 8 times. We're at the same price that the company was sitting around between 2014 and 2016. And the business is far superior to that. We're going to jump into that in a second. But just to show, you can see in 2015, the company was only generated $44 million in EBITDA. And now it's generating $75 million a quarter, right? In 2016, 85 million, right? Now we're doing 75 million a quarter. And we're at the same price in terms of share price. Now, part of that is the debt level is a little bit higher than it was back then. But the EBITDA multiples come from 15 to 12 to 8 to 5.5, right? Like, it's already been crushed. McDonald's, I just wanted another example to show you guys of a franchise model that really works. Obviously, McDonald's would be the high water mark given how well McDonald's is an operator. But the thing I love about franchise models is it rides inflation so well. So it's one of the things that I like to look for. And this is just, I was just trying to compare 2015 and 2014 numbers to now, right? Because we're getting the same share price, the same valuation. But the company is far superior to what it used to be, right? It only had 145 million in sales in 2015, right? Now we're doing well over $1 billion. So business only did $1.36 in earnings, right? Now we're estimating 4.34. So technically the business is about 4 times better, right? If you're doing it on an adjusted EPS basis. But we're getting the same share price. What else can I say? I thought this color was interesting on the call when basically it says same sort of sales on the other hand, not reach the level we've aimed for, but I'm encouraged by the sequential improvement in the US, which is important because I like when they're saying sequential improvement when the share price is saying no, it's going to get worse. So that's something I like to look at. What else is going on? The ERP implementation is finally done in Canada, and it's going the first phase in the US rollout and final phase scheduled for December. Canada go live was completed on time and on budget. This is important, ERP systems, and just really helps improve the visibility, streamline the processes in terms of inventory, enhance efficiency. And that kind of showed up in the working capital and the free cash flow statement. I think this will help them out as well, which is nice to buy into when that's finally over instead of investing while it's going on, right? So this will be also good when this is over. And we should start seeing more efficiencies there as well. I thought this comment was interesting. We know how much franchises pay, and we know how much they should have in food costs and labor costs. We have a good idea where franchises stand. Basically, when you're a franchise model, you want to make sure your partner, your franchisee, is in good shape. Are they making enough money? Can they cover their costs? Are they profitable, right? And one of the things is an important metric to look at, which I liked here, is we have a lot of current franchises who want to reinvest in the business, so open more stores, more franchises. And a lot of these new stores we're opening are coming from the existing franchisees. And that's what you want. you're not going to invest more if you're already losing money in your current franchise, right? This is also good news, and we are seeing finally some relief in terms of franchise and the franchisor relationship. Basically, if you were a franchisor, especially when inflation really shot up, you got to see a lot of return because you basically rode the sales revenue of the franchisee without having to deal with all the inflationary costs, whereas the franchisee had to deal with all that inflationary cost and try to push price. That's where the royalty increase was coming from, right? And so they were the ones getting squeezed and the franchisor was not. And so what we saw with McDonald's a few years ago, I want to say a year and a half ago, maybe 2 years now, was they actually started giving money more, supporting the franchisees more than they had in the past. And that actually made the share price kind of go horizontal for a little bit, if you look at it, right? Relative to its steady increase, like it is on a up, but you can see how steep some of these increases are, right? It went from $100 a share to 200, right? And then 200, 250, and it kind of sat around that for a while in the 250, 300 range, right? And a part of that is they were giving some extra money, I'd say, to their franchisees to support them. What else can we talk about? We have some better practices. If you shouldn't bring a SKU to a restaurant if it doesn't have at least 3 uses. I always like when they give specific examples of things they're improving on. There's types of initiatives we try to come up with where we're obviously trying to bring new innovation, but innovate within the existing SKUs, which is important. You don't want SKU overload. That's how you get scale, is with less SKUs. Innovate with what they have. We're also working with our suppliers to help reduce labor needed in our restaurants. A number of prep can be automated by our suppliers because they have better volume to automate some of these functions. So that's also something that's going to be improving. So these are also things that I like seeing, especially when they share them so openly on the call. It's like, okay, what are you doing? Like, what are you actually doing to improve the business, right? And I like that. Like, you have the ERP, you have the innovation with the SKU counts, right? And then the ingredients have to have at least 3 uses, which just helps de-risk the inventory. And then you have reduced labor by pushing some of it on the suppliers because they can do it better because they have the automation there already for them. The buyback, this is probably the one thing I think they could do better, right? You're not active in Q3. I mean, we're at 8 times earnings, 5.5 times EV to EBITDA. Why the hell aren't you buying back your own shares, right? Like, yeah, I understand you want to pay down debt, but really you're telling me you're trying to find something to buy and you're just making room for that future acquisition. And I'm like, are they cheaper than 5.5 times EV to EBITDA? Because it would be hard for me to win that one. But maybe they are seeing something. But if I was them, based on what I can see right now, and I don't see their deal flow or anything, but I would just, the NCIB looks pretty good to me. SIB would be amazing. But anyway, here's the debt level, 2.3 times, only 600 million in debt now. So again, it came from almost 800, now it's down to 600, right? So they've already paid off a decent amount, with the EBITDA still growing slowly year over year. So that's what I like to see, is there's room again if they want to start accelerating to make acquisitions. And there's also room for them to start buying back their shares more aggressively, especially given how much free cash they generate versus where the share price valuation is, right? Like, if we were to seriously look at the business, let's just assume you're going to make the same amount of FFO as last year. All right, or the CFOs last year, so 177 million bucks. If you were to buy back, so let's just say they didn't buy back any debt. So of the 177 million, they pay their dividend, so let's call it 30 million. So they have 140 million left to play with. You could buy back 140 million of $800 million now, right? That's what the company's worth, is only $800 million, but it's generating this much free cash flow a year, right? So it's just hard for me to say, why wouldn't you be buying back your share count aggressively? You could cut the share count by 10% and still pay your 3% dividend, right? You could really get the EPS up and invest back in your business for the long-term investor at the specific point when the multiples come in so much. But that's just me. We talked about the deal flow and how there's been more fixer-uppers in Chapter 11 situations, which is what you want to see when you're looking at buying a tuck-in play. So the reason why I'm doing the video. And then to end on the path to the coveted 100-bagger status, I just wanted to show how this business is growing from only generating 10 cents in EBITDA and only having $11 million in revenue, right, to being over $1 billion in revenue already, right, in 22 years, to having their EPS now go to $4, right, and now we're getting the same price as 2013, but the business does about 10 times more in revenue than this number now, right? The number of locations is now at 7,000, right? EPS is now at $4, but we're getting the same share price, and that's what I like. His expectations are coming in hard. Basically, the market thinks they can't do this anymore. They're not a good capital allocator, and we'll see. It's just an interesting time to look at MTY. I like to know your thoughts. I love tuck-in plays. I find them fascinating. More recent one we did, if you want to look at that one, was Dental Corp Group, though that one just got recently taken out pretty much right after I did the video. So anyway, I like to know your thoughts, and have a great rest of your week.